kind of is a happy Friday. I was making a list of all the things, whether it's Brexit, China, the Fed buying T-bills, extending repo. UMISH was good. How much faith are you putting in a day like today?
Well, I don't put too much faith in any one day. I look at the trade situation, and I'm really glad that we're not going to see the scheduled hike in tariffs, but this doesn't really resolve anything on trade. It doesn't lift the veil of uncertainty because all the tariffs we still have out there are still there. And the really hard mile to cross, the intellectual property mile, not the 20th century intellectual property that China's offering us, but the 21st century intellectual property infractions, that's not going to happen right anytime soon. So I'm a little concerned about uncertainty still weighing on the economy next year.
David, meantime, I mean, you've got the Dow just about at 500-point gains here today, so the market certainly seemed pretty optimistic. I mean, we've been in a pretty tight range, really, for the last year, if not year and a half. Is this going to be enough, at least from a market standpoint, of a catalyst to move to the upside?
Well, I think the big story today is actually, I sort of agree with Diane a bit. I think the trade story is still very much in flux, but the Fed just announced that they're going to buy basically somewhere around $400 to $450 billion worth of Treasury securities and do another $150 billion in repo operations on a regular basis. And that's over the next 6 months or so. That's a pretty sizable amount. I mean, we're bordering on what amounts to what we did in QE2. It is in the short end of the market, but it is adding a lot of immediate liquidity. And I think people probably are reacting to that in a way that is not they're not overreacting to it yet, but I think they're reacting to it correctly, that is a pretty sizable easing in financial conditions that's been announced by the Fed. And it's a little bit stealth because it didn't come out in a statement. It didn't come out in a sort of big hoopla of a typical FOMC meeting, so they're trying to make it technical, but it really isn't that technical. It's technically very similar, if not identical, to much of what we saw during the QE period. So I think that's a huge catalyst for the market. Is it enough to overcome some of the other issues that we have out there related to trade, slowdown globally, all the stuff going on in Hong Kong, China, and the relations deteriorating? I don't know, but you know, it's nice to see that we're back at 3,000, which is around there, which is kind of where we were at the beginning of the summer.
Diane, we've been having this debate for days now. Is this QE or is it not? And the Fed has been very adamant in saying it is not.
Yeah, it's not. Well, it's interesting is because the Fed did this before we ever got to QE. They were always buying and increasing the size of their balance sheet and keeping it constant as a share of the economy. It was by default. They thought they misread things when they got their big balance sheet on how far they could go back down again, and they learned the hard way. And I think I wish they weren't in the news the week that they, had their last meeting, and Powell actually did a great job at that press conference. I wish it wasn't in the repo market. They want to be non-existent, and this is how they feel they can be non-existent, and it means that they have to organically, technically grow the balance sheet to accommodate the needs out there given where we are. And it's just, we're never going back to the world we were at. This is the new normal. And it's going to be constantly setting a new normal because they knew it was somewhere between $1.5 and $1 trillion on reserves. It hit at 1.35. They didn't know that. They were taken by shock by that.
David, so then are we going to trade in that kind of uncertainty for political risk in the new year? And we keep hearing with increasing frequency concerns about margin, wage pressures, downgraded Delta today for that very reason. What do you think?
Well, look, I mean, the wage data that came out, the average hourly earnings broke back down below, 3%. The CPI missed to the downside. The PPI missed to the downside. I think the other piece of information that's actually important for the market to digest came in the Fed minutes about how they're thinking about changing the framework and the makeup strategies. That was an important piece of information because in Q1, we may get a framework change. My base case is actually that they sort of announce it but delay it a little because I think a real framework change would cause a significant easing in financial conditions. You'd need to sort of get a lot more rate cuts or more QE in the system if you want to make up for all these inflation misses of the past 3 to 5 years, or certainly whatever number they decide. So I think they don't necessarily want to do that in an election year, and there'll be a lot of political jockeying around that. But the Fed is going to do it, and maybe it's a 2021 event. And it's a very positive storyline from a financial conditions standpoint and for the market over the long run.
But you can forgive viewers for being confused then, because core is running, 2.4? Right. 11-year high? I mean,
right.
And yet we can...
And when you ask people, Esther George was in Denver. I just saw her this last week with Jay Powell. And, she said, listen, when you talk to Main Street, they say, what do you mean inflation's too low? They don't get it. And, the Fed hasn't come to consensus. This is a real issue. And the idea of what is symmetry in this inflation target, we can talk about it in financial markets, but the reality is nobody really gets it on Main Street. And that's one of the reasons I think Jay Powell's hiring a speechwriter so he can speak.
I saw that job opening.
Yes, as a job opening, to be a little more plain spoken, to speak to Main Street, and also make sure the messaging. All the work that the Fed did internally said, if we're going to do catch-up strategies where we overheat and run a high-pressure economy, they don't work unless you can communicate it to the public. And guess what? That's one thing the Fed does very poorly.
So, Diane, here's what I want to know. You got rate cut odds dropping amid these this market rally and all of this optimism that we're going to get some sort of at least truce, if not some sort of skinny deal on trade right now. Does the Fed actually cut later this month?
I wish I knew that exactly. I don't think they do right now, but it really is contingent on everything we get between now and then, like retail sales, the GDP, which is going to look less than 1.5% on the third quarter. I think they hold their fire until December because I do think we're going to have a weak fourth quarter as well, and they're going to feel they're going to need to give a little extra boost, and I don't think this trade uncertainty is going away. We still got to get the new NAFTA passed, which doesn't look very likely right now. So all those things will play in, but I think we get a pass on October. But thinking about it, their meeting's October 30th. October 31st is Brexit or not. Right now, it looks no.
So
what will it look like in 2 weeks?